Hello and welcome everyone to the TIE's Innovator series. For today's webinar, I'm pleased to be joined by Function, Marinade, and XSY, and we'll be discussing leveraging idle assets to generate yield on-chain. Before we get going, little reminder that all the information contained in this webinar is for informational purposes only and not intended as investment advice. So that being said, let's dive in and let's start with a quick round of introductions. So we'll get a high-level overview of each of the panelists, your organization, core missions in DeFi. So Thomas, why don't we start with you? Could you tell us a bit more about Function, FBTC, what your role is in shaping its strategy and establish Bitcoin's institutional yield standard?
Yeah, absolutely. Happy to kick things off. Hey, everybody. So my name is Thomas Chen. I'm the CEO of Function. I joined about 4 months ago. Previously, I spent just under 7 years at BitGo running sales, looking after what I call the fun stuff, everything related to crypto native. A very quick story, which is the observation that I had at BitGo back in 2023 was BitGo hit like 100 billion assets under custody. 40 of that was just BTC doing nothing, paying custody fees. So the question that emerged was, how do we monetize this? How do we turn our clients' assets and help them turn Bitcoin into a productive asset, right? Asked differently, what is the safest way to earn sustainable and scalable yield on Bitcoin? So our vision is that Bitcoin will become the reserve asset for DeFi. I think that's only accelerated with MicroStrategy and publicly traded companies adopting the Bitcoin standard. So our role is to build that institutional grade infrastructure to facilitate a productive Bitcoin asset, starting with our flagship asset, FBTC. And then just some key stats. Right now, we have north of 1.5 billion in TVL. We're live on 10 different chains, 10 plus different chains. And we also have the privilege of having Galaxy and Antalpha as our backers.
Awesome. And then Hadley, over to you. So could you tell us a bit more about Marinade, the core functionality within the Solana DeFi ecosystem, and what your role when it comes to the institutional roadmap?
Sure, yeah. So thanks for putting this together, and great to be on here with David and Thomas. So Hadley Stern, Chief Commercial Officer at Marinade, coming up on a year. Marinade's kind of an OG protocol, so it's been around for 4+ years. Its original genesis was the first liquid staking token on Solana, born out of a Marinade hackathon. And now the project has over $2 billion US of total value locked up on our staking platform. About 18 months ago, we made a pivot to really focus on the institutional market, and have had some great success there. And part of that pivot was making native staking available, which I can talk through some of the nuances and the reasons why native staking is really better for institutions on Solana. We've got great headway, recently integrated with some custodians, including BitGo. We're part of an ETF application, Canary Marinade Solana staking ETF, and really at the forefront from a technical product regulatory standpoint of helping institutions get involved in staking.
Awesome. And finally, last but not least, David, can you tell us a bit more about XSY.fi and Unity, and Unity's role in offering institutions ways to make their stablecoin balances more productive?
Yeah. Thanks for organizing this as well, Sacha. And so I'm David. I'm the Chief Operating Officer here at XE, or XSY, as many people have come to call it. Prior to that, I was one of the first business hires at Algorand. I helped grow that ecosystem from before launch through scaling TGE, capital markets, venture. That was a great ride. And one of the things we really uncovered at Algorand was that there is insatiable appetite for these products to live on chain, to access these markets, but it's really complicated. It's really difficult to put this capital to work in a systematic and sustainable way. And so our role, our mission here at XE is to reduce that complexity and simplify it into the same structure as, buying Bitcoin or buying FBTC, and really abstracting away a lot of the complications that otherwise you'd have to manage 24/7, 365. And so with that, we've got a dollar building block that we call Unity, and then we have a yield vault. And the yield vault is the first strategy that we've implemented where we're allowing capital to be put to work in the perpetual futures market. And so the net result is that we can generate about, double-digit yield on an annualized basis with a Sharpe ratio of about 3.4. And so we launched about a month ago. We've got $30 million of deposits, the vast majority of which are institutions at this point. But we're really looking to make it easier for people to access more complicated strategies.
Awesome. And yeah, now I remember I always make the same mistake with XE, but I always see it as like excess yield. So that's why. Awesome. So let's start with the big picture. How would you describe the current state of institutional engagement in DeFi specifically, right? Because it's the centralized part, but more specifically in DeFi. Are we still in the early innings, or have we been able to reach an inflection point, and how do you see this evolving?
I'm happy to take that one. I want to start with this. There's this meme. I think it's from the Umbrella Academy, where one person's driving a car this way, the other person's driving a car this way, right? And I bring this up because after going to several conferences, I'm starting to see that the folks in DeFi are thinking, all right, we could tokenize RWAs and put them on chain, right? DeFi, capital efficiency, great. And then the folks in TradFi are like, oh, we could recapitalize our balance sheet with Bitcoin and put them in public traded markets. So it's like, we're all trying to do something similar with the tools that we have and things that we're familiar with. I do still think it's early innings because we don't have any, as far as I can tell, any institutions. And when I say institutions, I mean like asset managers, regulated financial institutions, embracing DeFi protocols. We're not there yet. I don't think they're able to underwrite the smart contract risk today, but they are asking, right? There are, according to Bitcoin Treasury and the Nakamoto group from Bitcoin Vegas, I think there's north of 80 publicly traded companies that are adopting the Bitcoin standard. That, of course, was kickstarted by MicroStrategy, and that'll continue. But what happens if you are the 200th one, right? They're going to start asking, okay, now that we have BTC, what can we do with it? And I've actually spoken with very, very large TradFi custodians and asset managers who are starting to explore this. So I think things are accelerating quite quickly.
As you were stating your question and reflecting on Thomas's comments, I was thinking a little bit about, what we mean about DeFi, because 6% of Bitcoin is now tied up by ETFs. Do you define that as DeFi? I mean, Bitcoin is like the OG DeFi protocol, decentralized. It's not really DeFi in terms of how we think about DEXs, but it depends on how wide your parameter of definition is. So I'd say on the very early side of things, obviously there's extreme, 6% is pretty extreme. I think the top 3 or 4 wallets now on Bitcoin are ETFs, which is kind of crazy, with Satoshi still there at the top. But when you go further down the stack of tokenization, participation in DEXs, obviously it's very much more nascent. But I think all these things build up upon each other.
Yep. Yeah, and I think for the purpose of this conversation, maybe it's more framing DeFi as sort of like on-chain rails, fully on-chain rails, because of course, the decentralization aspect is always a bit more tricky.
Just from a anecdotal perspective, the conversations we were having at Algorand in 2017, the line of questioning was largely centered around like, what is a blockchain? How does it work? What do you mean a node, right? And I'm being a little pithy, but it wasn't too far off. And now fast forward here to 2025, and the questions are more, what are your counterparties? What is the system behind? What protocols are you hitting? What's the track record? How long has that protocol been alive? And so I think that in and of itself just represents a massive shift. And I think it's not going to be the institutions that ultimately lead the charge. I think it's the capital side that is departing from those walls, moving to more crypto native DeFi aligned, rails, and then the rest of the institutions are going, oh, maybe we should custody some Bitcoin, maybe we should offer custody for Ethereum, so on and so forth. So yeah, I think we're at an inflection point. But to Thomas's point earlier, we haven't really, pivoted over. Some of the large household names aren't doing DEX swaps directly yet.
Yeah. And also another thing that, people, to your point, right? The thing that people often forget is how a blockchain works. That's very foreign to TradFi. How yield works, that's their bread and butter, right? And what it means, like building all those financial instruments, that's their bread and butter, and they know really well how to do it. Now there's additional smart contract risk and everything on top of it, which they need to get familiar with. But the financial aspect of things, they're very familiar with it. So what specific signals have you guys seen from, whether clients, counterparties you mentioned, regulators? Have you seen signals that are validating a more institutional appetite for these types of yield products?
I would say, to piggyback off of David's point, a lot of the yields, and in your point too, Sacha, the yield is still very much TradFi or CFI based yield. The type of yields I'm still seeing are covered call strategies, right? Options. I don't really see them interacting directly within DeFi. If you define DeFi based yield as, to me, it's a function of trading, borrowing and lending, or staking to generate the yield. I see version of staking, right? Hadley could probably speak a lot more to that, but I don't see any. I think what you're trying to get at is like the core of the DeFi innovation. It's certainly not there yet, but we're having these conversations.
Yeah, it's again, it depends where you think on the stack of institutional. You have at the most conservative top the sort of buy and hold strategies of ETFs or MicroStrategy. And then you're going to start to see, staking come within ETFs. And that will be another way, especially for something like Solana, where, unlike some other proof of stake chains like Ethereum, where the yield is only 2 or 3%, with Solana, it's 9 or 10%. So you're going to see strong demand for it, I would expect, in the Solana ETFs. But then further, down the stack, some institutions are getting very savvy in DeFi. They're buying liquid staking tokens like MSOL. They're using those to lend and loop. And so, there's sort of a variety of sophistication and use cases. What I would expect to see eventually is that digital assets are going to start being used in traditional collateral within TradFi. So they'll be operated even at that level, and there'll be this real merging of these two worlds.
And yeah, just in terms of like raw signal input, I think Chainalysis reported that like 70% of the North American transactions that they are monitoring were like exceed $1 million per transaction. Tokenized treasuries are up over $1 billion, across various issuers on chain. Like the total real world asset space has gone from something that was, a meme that we used to talk about in 2017 to like, I don't know, over 10 billion. You have people like BlackRock now playing, et cetera. So like in terms of raw feed, like, yeah, it's happening, early innings, but these are real numbers, real yields.
I do want to double click on something that has an overlap between the Bitcoin world and the stablecoin world, right? With David, which is, for Bitcoin yield, Bitcoin does not generate yield natively, right? So really, what is it used for? It's really used for collateral, to borrow stables. And so from an institutional standpoint, they have to think, okay, well, to borrow stables, if it's using DeFi, you're looking at an Aave, right? But then how do we understand how do you measure the volatility of Bitcoin's price relative to, the health factor of your borrow on Aave? What if it spikes? Right, you don't want to get liquidated on your Bitcoin. So those are all little things you got to consider and really understand, and to underwrite the DeFi risk in order to take advantage of Bitcoin yield in DeFi specifically.
Mm-hmm. So let's actually shift gears and move to that and give a quick ecosystem overview and strategy of DeFi institutional yield, no pun intended. So Thomas, you guys recently rebranded FBTC as the Bitcoin Institutional Yield Standard. How does that rebranding position you to capture that institutional demand for Bitcoin yield products? What does it consist of, and what are you guys focused on there?
Sure. So we did a recent rebrand from really positioning ourselves as an asset issuer. Being an asset issuer on Bitcoin, like a wrapped asset, is a hard life to live because there's just no yield, right? It's not like USDC or USDT that I can throw into risk-free treasuries. So we're repositioning ourselves as more of the on-chain Bitcoin earn destination, right? Curated opportunities. So I'll give you one example of how we exist today. If you're a user on Bybit, if you go to their earn page, you can actually stake your BTC. From a user perspective, they click one button and they get some sort of APR for 45, 90 days. They don't even have to know. It's actually us in the background underwriting the risk, right? With the security stack that we have, deploying into single clean strategies that have a Lindy effect, right? That's known. We're not doing anything sophisticated, but that's the world that we think DeFi is trending towards, a world where the access points look like vaults. We're certainly not playing in the DeFi points farming space. We're not in LST today, but ultimately I do see a world where we want to be top of mind when institutions think about, hey, where can I get high integrity yield on Bitcoin, baseline 3 to 5%. We want to build the infrastructure for that.
I think just adding on to that, it's also interesting to talk about the different types of yield and the different risk profile. And I think that's how some institutions are looking at this. So when we look at something like Marinade staking, that's a protocol level activity. It's not really a financial product. The inflation rewards are built in at the protocol level. They're public. They're documented. So we would argue, of course, that that's a lower risk activity, which I think has the added advantage of being true. And then you kind of go up the stack of risk, which typically leads to more rewards, right? Whether it's lending, whether it's looping and multiplying, whether it's perps, all these other types of DeFi products that some institutions are wary of and some institutions are really starting to engage with, and beginning to have this sophisticated portfolio theory approach as to what they'll allocate to each of the different types of DeFi products.
Yeah, well, and then you also have DEXs that sort of have rebranded market making risk, liquidity provisioning risk as yield.
I think this is also how you see, in the public markets, you just see like single ETFs, right? Single asset ETFs. I think as it continues to evolve, you'll see a mix. But as of right now, they want to constitute their portfolio with just BTC or ETH, right? Or Solana. Yeah.
Awesome. So going over to you, Hadley, you guys were named Marinade Select was named the exclusive staking provider in Canary Capital's US Solana staking ETF in their filing, right? So how does that reshape your go-to-market approach for institutional Solana? And what lessons have you learned from that, and will you apply to future ETF products?
Yeah, great question. Thank you. So, Marinade's a little unique in this space in that we actually don't run any validators ourselves, which gives people some pause when we're talking to them. We're a multi-validator and have been from the beginning. And really that serves two purposes. One, to help with the continued decentralization of the Solana network as it emerges to be the largest network in terms of activity on chain. And then the other is to help end stakers get the highest APY. As we went to the ETF market with the product, one piece of feedback we got is even though we block OFAC nations, the validators in the current model just connect with us at the command line interface level. And some of the ETFs were not comfortable with that, which is why we've introduced Marinade Select, where from the word we've selected 30 of the top performing validators, professional validators, and there they go through a KYC, KYB compliance process to be included in this set. So the ETF providers get the advantage of decentralization from a supporting the network and contingency standpoint, and while also understanding where they are. So that's resonated greatly. We launched it about 2 weeks ago. We already have about 800K SOL staked through Marinade Select, and we're very bullish on the growth of that. This just speaks to, again, as DeFi entities interact with TradFi, there has to be some give and take on how these products can fit in, to say the least, to the requirements of institutions. Having sat at Fidelity and Bank of New York Mellon, I know very well what they're like. And as the industry evolves, that we'll continue to innovate together.
Yeah, awesome. And David, over to you. So the Unity's yield, right, is derived from delta hedge strategies using native L1 tokens. Can you explain to us the mechanism and how you communicate this with institutional decision makers? What are the types of risk and return trade-offs, and how does that work from an operational perspective?
Yeah, a lot to unpack. I'll do my best to answer all of those questions in as succinctly as possible. But before I dive into the specific product, I think at the highest level, what we are all talking about here is portfolio construction, right? I mean, if you just boil it down to, hey, there's bonds and then there's options, right? And that's basically what people are ultimately choosing between is, do I want something that fits more in my out on the risk curve profile, or do I want something that's a little more principally protected, right? And that's what we have strived to create here with Unity and our yield wrapper. So as you mentioned, we use delta hedge strategies here to basically offer a principal protected note that allows you access to the funding rates that the centralized exchanges pay for access to that liquidity. And so the net result is a fixed income risk profile with what we think are very compelling returns or equity-like returns for that position. Fully on-chain, audited, it auto rebalances, so it takes advantage of all the goodness of blockchains, but it's packaged in a way that I think a lot of financial institutions and capital allocators can immediately understand, right? And so where this gets even more exciting, kind of tying back to Thomas and Hadley's product, is when you start looking at your portfolio holistically and tying these two things together, right? And so we have people who will borrow against their FBTC or their BTC and then deploy into our stable and earn that 11, 15%. And then on the back of that, they might use that yield to go TWAP into Marinade's MSOL. And so now you have this nice composition of, that the stables you're borrowing are being put to work in one of the most capital efficient ways possible. And that allows you to systematically buy your other option or the other product that you're interested in. And so I think the combination of these things really starts to get into like an attractive portfolio for the allocators and the institutions that are out there.
Super.
Just to add to
Yeah,
David, briefing a little, because I absolutely agree. This is where things are remixing. We're actually going to be, we've just announced we're launching something called Marinade Recipes because of the Marinade company name, but it's basically stake your sol and get your yield, your staking rewards in BTC or in our real world asset or another token. So this, this is where DeFi comes into play at the atomic level to be able to allow us to innovate these ways where it's not just one thing, it's many different things that you can do from one type of activity, which is really exciting.
I think it's cross-asset yield stacking, but also I heard there's like this, the Superstate team is building a way to tokenize equities onto Solana, right? So imagine you have a tokenized ETF on Solana that you can use as part of this portfolio strategy. It becomes very, very interesting.
Yeah.
Super interesting. So now how do we scale that, right? How do we scale institutional yield? What are the risks? What strategy to adopt? What type of cross-chain integration are required to access those yields? So maybe Hadley, let's start with you. How do you present Marinade's native security advantages to institutional risk teams? What criteria should institutions use to select validators or diversify those risks? And what are the and reach optimal risk reward ratios?
Yeah, so this a lot of this is very Solana specific. So Solana, unlike Ethereum, has some interesting advantages natively. So in Ethereum, you need 32 ETH to stake. In Solana, you need 0.01. In Ethereum, it can take a week or 2 weeks to unstake. In Solana, it happens every 48 hours. And then, very interestingly, built into the Solana native protocol is this security idea of you can maintain custody of the Solana in your wallet, delegate it to a validator, but you retain withdrawal rights. So this is critical to something like an ETF, or actually really anyone. A lot of the family offices we talk to are very interested in this. What this means in a disaster recovery scenario, if Marinade goes away, people still have access to unstake their Solana from the validators. So for those very specific reasons, we believe native staking is the preferred element. The one area where LSTs help is liquidity. And so we're actually building an instant unstake product. It's already in alpha, and it will be launched in Q3. That will allow anyone to instantly unstake from a Solana native validator, whether it's with Marinade or not. We're opening this up to the community. And there'll be an RFQ system on the other side with market makers. So an ETF, if at the end of the day they need to do a redemption and they're, say, 8 hours into the 48 hours epoch, they can make a request for that Solana from a market maker. The market maker would deliver the Solana, and the stake account would switch ownership. So yeah, native staking really is the most secure way for someone like a fund or an ETF or an institution to stake, which is why we made that pivot about 12 to 18 months ago. One other data point, 90% of Solana stake is already natively staked. So unlike in Ethereum, LST really is the exception rather than the rule in the Solana world.
Yeah, because the timelines are so compressed. But then for Bitcoin, you don't have native staking, right? So Thomas, that being said, right, FBTC now enables BTC yield across Solana, Ethereum, Base, and other chains using the omni-chain framework. So what are the factors that guide institutions when allocating Bitcoin liquidity across multiple on-chain yield venues?
Yeah, I'll talk about 3 primary vectors of consideration, and then we'll use a real-life example, Solana, here, just to make things a little bit more concrete. So the first one is all just things around, all right, where is the yield coming from, and is this sustainable, right? The second one is, what are the risks I'm taking on with regards to the smart contract, with regards to the specific dApps I'm deploying on, and then operational efficiency, right? Do I have to do any integration? Are the execution fees? What's the withdrawal time? There's a list. When we do the evaluations for our LPs, there's probably a set of about a dozen or so factors. And then depending on the LP's risk profile and how they want to express their view, right, they place different emphasis. But if you take Solana, for example, when we look at Solana as a chain, okay, Solana wants to grow BTC TVL. What is the target APR return for our clients? For institutions, generally, they want to get at least 5% on the BTC. Then the question becomes, well, what's the historical performance and source of these yield? If we look at Solana today, there's some interesting incentives being run by, let's say, USDG, Paxos, right, on Camino. So there's a path in, and as well as Maple, they launched a market there too. So there's some opportunities where you can, maybe not through looping, but just supplying in these markets where you can get north of 3%, maybe close to 5% with additional incentives or subsidies. Then it's like risk clarity. If we're looking at Camino, if we're looking at Orca, these DEXs, what are all the considerations? Just to borrow a recent example, right? Even the largest DEX on like a SUI, CETIS, right, was compromised recently. So these are pretty in-depth technical considerations when we're thinking about how to actually achieve that yield, right? Where do you have to deploy in the ecosystem? And then lastly, from an operational efficiency perspective, is the withdrawal time, is there a queue unbonding period, or is it pretty instant? Is the liquidity being given back in Solana tokens, or is it in a specific dApp token? These are all different considerations as well.
Interesting. Yeah, and so David, tell us a bit more about the mechanics of minting UTY and how, and issuing the YUTY, XUTY, given large deposits. Do you guys have any circuit breakers or liquidity backstops in place? in the event of large extreme withdrawals? How does it work? And brace yourself, but I think that's going to be super interesting.
Yeah. So coming back to the original question of how do we unlock more institutional adoption, right? I think Hadley alluded to one thing about making sure that we have the right KYC, KYB infrastructure in place. Well, we implement a very similar solution where only allow listed customers can direct mint UTY through our front door, right? And so via that venue, they can supply collateral. Today, we accept AVAX, USDC, USDT. Via OTC options, we can accept basically anything. And with that collateral, we ultimately provide it to a custodial account. So Copper, Sifu, Fireblocks for some more bespoke type of yield offerings. And then that gives us purchasing power across a number of venues. So the centralized exchanges, Bybit, OKX, Huobi, so et cetera, et cetera. There's a long list of centralized exchanges out there that offer these financial instruments. And so that's the flow of funds for how we ultimately are enabled to put on these various strategies under the hood. In terms of how we manage withdrawals, so to Thomas's point, we do institute an unbonding period. So there is a 7-day redemption. There is a queue that's implemented. With regards to liquidity backstop, so we have an insurance fund that we've modeled against the drawdowns of the strategy so that the peg is always secured against the historical backtesting that we've done. And then we also have lines of credit that we are able to access against our equity and our balance sheet that we think give us ample buffer to spill over effectively. And so that's the kind of the back office. And then we work with partners like Thomas when he's doing his 12-step due diligence questionnaire to make sure that our operational security, our key management, all of the things that go into running this systematically and at scale are top-notch, audited by the best firms in the space. Again, with I think a collective goal here of getting more dollars in because we're just abstracting all of the complexity. Like you don't need to spin up a node. You don't need the command line. You don't need to do your own risk analysis of Camino Finance or Maple or the counterparty risk. Like that is our job. That is what we collectively on this call do.
And now that we've heard a bit of how each of your products work, what I really love in DeFi and in those webinars is when you can bring the whole thing together and really see the interoperability. So in what ways can institutions combine MSOL, FBTC, UTY tokens into a more cohesive multi-layer deal strategy and still effectively mitigating cross-protocol risks? How would that work? And any of you can chime in.
I think that's kind of the $1,000 question, and there's this emerging job role of portfolio manager. That it's one thing to run a portfolio fund of equities, which is complicated. It's another to run it for DeFi protocols where you've got a whole other set of qualitative and quantitative challenges to work through. And I think that's where the secret sauce is going to be. Probably the people on the most cutting edge of this are crypto hedge funds, who have been doing this for a while, and this is what they live, eat, and breathe, where they're thinking of a mix of token investment, DeFi product, things they can do in DeFi on top of those, lending, collateral, etc. So that's the world that we're moving into. That I'd say it's very, very nascent and very specialized.
Yeah, from like a portfolio manager perspective, right now, the easiest way for them is to just have an account effectively with each one of the companies on this call, more or less, right? You go and acquire MSOL via Marinade, you go acquire FBTC from Thomas, whether it's on Bybit or other distribution partners, and then you can just go to our web app. Of course, you can onboard with us as well, and then you would do your own composition. I think, as Hadley was alluding to, where this starts to get really exciting is when we have a vault front end or a vault interface, as Thomas was referencing, where it's one button, here are my sliders, here's my risk tolerance, and okay, I'm going to deposit BTC, take a loan out in stables, deploy that in UTY, and then all the cash flow generated off of that I can use as cushion to recollateralize my BTC position, or I could go buy something else that I'm interested in, right? And so that's where it's all coming together. But again, we're just getting everything connected.
Yeah, it's programmable treasury management, but this time the risk exposure, if it's on chain, right, it's 100% transparent and you know how it's done. But then that also forces the hedge fund or portfolio manager to really understand Aave, right? To really understand these key puzzle pieces as part of the value stack, more so than like a counterparty risk, right?
Yeah.
Yeah, and
your
also,
counterparty is a smart contract.
true. Yeah, I mean, and there's like all the auditing around, right? The security risks, the smart contract risks. That's could be included in counterparty risk, but it feels like a separate, different type of risk, right? And by the way, Hadley, do you have any estimate, if not no, of like market size for these portfolio managers, emerging portfolio managers?
Like the hedge fund portfolio manager.
For these yield strategies, any idea of how big of a market size that would represent right now? Or
I'm not being very helpful, but I actually don't have any numbers off the top of my head. I'm not sure, David, if you have more experience in that area. I will say it's early, but I'm not sure of any numbers.
And I guess the point is it's something really scalable, because when you can really put it under a framework that TradFi understands and the ecosystem grows, then it can really grow dramatically. So in terms of working together for ecosystem projects, right? What type of partnership frameworks work, right? Is it rev share, co-investment on pools, white label services that some of you hinted at? What have you found to be most effective for scaling institutional adoption there?
Yeah, another interesting question, because everyone wants their cut, and so I'd say it's often, hopefully a blend of rev share that's helpful to both teams seems to be the way the industry is moving. And then, in some of the, the more DeFi things, like on places like Camino, there's also deals to make tokens available and add liquidity that way. So it's partly product and then partly rev share.
For us, I think at the core of it is figuring out what everybody wants and alignment around incentives first. If you can find that alignment, then whether it's rev share or monetization opportunity discussions become a lot easier. In the previous, if you call it a cycle, I think what was a great experimentation was, what if we use this concept of points meta as a way to do liquidity mining, right? And I think that did work for a lot of these projects. But I think at the end, what happens when you want to start redeeming it, it becomes a little bit messy and unclear. And I don't know how you would price certain points relative to other things. It becomes a little unwieldy. So I think there's always experimentation in DeFi. But yeah, my gut is saying that some sort of rev share is probably the one that makes the most sense.
Yeah, I would say that rev share is like the low-hanging fruit, right? To Hadley's point, everybody's interested in how much am I going to make if I resell or repackage this in some way, shape, or form. But what I will say that has at least been a huge boon to us in the early innings here is offering a concierge-like service, right? Where just in this conversation alone, if you aren't in the space, it probably sounds like we're speaking a different language half the time. Even if you're in, crypto on a regular basis and you are sitting at a TradFi desk, you still might not know some of the nuance that, we are kind of glossing over or breezing through here. And so from our perspective at XE, helping people really understand every step, what their money is doing, how it's being deployed, the options that they have, them becoming product partners on the back end of, it would be really nice if I could do X or Y. That to us has been, really the big unlock in terms of getting more capital in the door.
Yes, and to double click on this, like really enabling institutional participation and getting to the right level of market readiness. We just saw this week the Genius Act was passed, so there are things moving on the regulatory side. And so under the current US regulations, what are the immediate steps that institutions can take to earn yield on their idle assets? What infrastructure or policy changes will be needed in the future to enable a broader adoption of this? And what are your thoughts in general on the regulatory topic?
I have a view for the second half of your question, which is what are some of the blockers? So I talked to, and this has come up to us as well. I think David said, like, vault managers effectively are just decentralized hedge funds, right? And the vast majority of them, probably all of them, are just operating offshore from a regulatory standpoint. So then the question becomes, at what point is there going to be regulatory clarity as to whether or not a, call it, name your favorite TradFi institution running these strategies is not considered an investment advisor or investment manager, or maybe they are, but they just need some more clarity around that. Because right now, all the vault providers, and there's some really good ones, but they're not like your Fidelities of the world, right? Imagine if there's a vault that's actually managed by Fidelity on their side. That would usher in a lot more capital flows.
Yeah, I mean, I'm going to be very kind of boring on the Marinade side. So, our sort of line is, if you have Solana, you should stake it. And if you stake it, you should stake it with Marinade. So, that's kind of our call to institutions. I would just say, I think if I was on the institutional allocation side, I'd be starting through and mapping out what my allocation strategy is, how aggressive I want to be in terms of, do I just want to play the game and just be in a few assets, or do I really want to notch it up and really get involved in some of these other products that David and Thomas represent? I would say institutions should. It's a great time to learn. It's so early. There's so much to learn as well. And I think inevitably these products are going to blend with TradFi anyway. So may as well get on top of things now.
If I may add a quick example, just like these pubcos adding BTC on a balance sheet, what would a world look like if they added FBTC? What I mean by that is the story of adding BTC on a balance sheet, that MNAV premium is going to compress over time. But what if all of a sudden they have FBTC and that gives them, make this up, 5% baseline yield? They could then take that yield. That yield could be constructed also by taking FBTC, putting it in Aave, getting USDC to swap and mint Unity, right? So like, there's some very interesting things you can do in the back end of this. I don't know what the regulatory view is on that, but you can see where very quickly there are ways to combine TradFi and DeFi.
Yeah, Sacha, I think the short version is that we need clarity here in the U.S., right? It's hard to know what activities fall under what jurisdictions absent that. And so the Genius Act is a great step in the right direction. It's not all encompassing, but it's heading in the right direction. And then as a byproduct of not having that clarity, you kind of have two markets that are growing up simultaneously, right? You have the institutions that are largely just toe dipping into BTC, maybe ETH, doing it in terms of ETFs, looking at staking now that some guidance has been published around staking and whether or not that is a security, right? And so that's kind of their crawl into the space. And then to Thomas's point, we have this, kind of niche hedge fund, boutique market, which, oh, by the way, each one of them is now deploying somewhere between $200 and $1 billion, $200 million and $1 billion of capital. And so what does that start to look like? Do they merge? Does it collapse? The story is old as every industry, right? There's a bundling and then a rebundling. And so once we get that regulatory clarity, I expect that M&A will be off to the races, because all the institutions that are offering Bitcoin products are going to very quickly want to start offering all of these others. And who's best positioned but the people who are building on chain, who are running these strategies. So I think we need clarity. We're not going to get it all in the Genius Act. I'm optimistic that we're going to get more here, over the next 3 years. And then I think, money will start flowing through Fidelity, and Fidelity will use some combination of partners and acquisitions to ultimately service those products.
Yeah, the next big piece after the Genius Act is then tackling market infrastructure. And so once that's done, that's when a lot of these things will sort themselves out, hopefully.
Yeah, and once we get into that adoption phase, then what's a good way to measure that? What are the KPIs that should be tracked. Because another aspect that I imagine as well with institutions is sales cycles, or the time it takes to get to do something is a bit longer. So what are the KPIs you look at to incorporate all these aspects, and how do you effectively communicate these metrics to support your decision making and build trust?
Well, so one of the things that's near and dear to our operations is the transparency on reserves. And so we are working with partners, because to Thomas's point, what you see on chain can sometimes only be half the story, right? There are many times other lines of liquidity or other off-chain facilities or other products that are being included to compose a portfolio or come up with a strategy. And so all of our counterparties, they want to know, this is the exposure they have across venue. This is how capital is, being managed. And so fortunately, by being on chain and by having everything basically be driven off of APIs, we can not only provide that, but we can also do it through zero knowledge proofs and verifications with our partners to say, hey, we're not only is this our APIs, but then they've been verified by third parties as well. And it's encrypted and it hasn't been tampered with. And so I think that's a real big unlock for the space, is enabling that level of trust, transparency, and moving away from the, hey, just trust me kind of mentality that crypto is plagued with for a little bit there.
Yeah, I think TVL is just a low-hanging fruit to just point to and say, okay, we have that much. But with TVL, it gets a little tricky, where it could be muddied on exactly how that TVL is calculated, whether or not that protocol actually holds the backing asset, or if it's just like a representation of it being from somewhere else. So you really have to get to the root of the proof of assets, to David's point, right? Like, who controls that wallet? Who ultimately has control of that wallet? I think similar to people measuring in and outflows of ETF, that'd be interesting to know as well, into these vaults, how they've changed over time.
I think another interesting metric, to the extent that we can measure it, is going to be, institutional wallet activity across chain, and what that will look like. I'm not sure how that would actually work. It depends on how public things are, but that will be an interesting metric to watch.
Interesting. Yeah. So basically, breaking up the wallet activity with some sort of labels to try and have an understanding of. Yeah, that's super.
Yeah.
It's a very, very interesting point.
That one I think is probably tricky as hell.
Yeah.
Because they don't want to tell people where the wallets are from a hack perspective. So, maybe that's where the audit firms step up and do more regular publishing of the balance sheet.
Mm-hmm. Yeah. Yeah, and what are the global markets that present the biggest opportunities? Maybe the toughest regulatory hurdles as well, but what are the big? Where do you see the biggest opportunity in institutional DeFi liquidity?
I mean, not to be American centric, but I think it's here for a combination of just the amount of capital and then now the regulatory environment. That said, saying Asia is a huge overgeneralization, or APAC, because there are so many different subsets to the region there. But there's also a very interesting, different way of thinking about DeFi and financial services there that is also very interesting as well.
Yeah, I mean, we've seen a lot of the focus really moving back to New York in the past couple months.
Just to throw in an anecdote, a non-US centric anecdote. I think South Korea just published a stablecoin guidance that basically said, if you have more than $350,000 of assets, you can be a formal issuer of a stablecoin. Now, we could opine as to whether or not that is prudent regulation or what that means. But I think what it is representative of is that there is a giant appetite for experimentation outside of the US as well, right? I mean, certainly Singapore has been out in front on a lot of these issues. The UAE has been publishing forward-looking guidance. Switzerland has had their own regulatory environment. Even the EU has had their own sandbox with stablecoin issuance, kind of leading the charge ahead of the US. And so there is certainly a lot of experimentation. There's a lot of demand, clearly just driven by the amount of dollars that are flowing into this ecosystem. And then, stable coins seem to be very much in vogue right now. And so I think we're going to see a meme moment for stables here is over the next, few years.
It also depends on demographic. I think if you look at it from a retail lens, then you can consider like Asia or larger APAC probably leads, definitely with respect to BTC and the assertiveness on the risk that they're willing to take on. And then Europe probably follows, and then US actually lags. But for institutions, I would agree with Hadley that the US definitely is the bulwark, and we're waiting for the regulation to come out for institutional money to come in. I mean, just look at the public equities market. The US is the only one that really matters.
Yeah, and speaking of getting exposure to stablecoins, Circle is up 20% on the day to almost $180. So
Wow.
there is a lot of appetite there.
Hey, good job, Jeremy. Good job, Cash.
So a couple more questions and before we close out. So what major developments should we be expecting for in the landscape for 2025?
I would say on the regulatory side, market infrastructure bill that will lay out a lot of some of these questions we've been talking about here in terms of how these markets will be able to operate. On the ETF front, selfishly, staking ETFs, including for Solana and Ethereum, coming to market. And so an expansion beyond just Bitcoin and Ethereum. And then I think continued innovation from folks like David and Thomas in terms of new types of products that are going to be built and brought to market that will just continue to accelerate, and expand what DeFi means for the institutional world.
I'd say, given the velocity of a lot of these publicly traded companies adding Bitcoin to balance sheet, you'll probably see an increase in price. But also, not all these companies probably have the same operational rigor as MicroStrategy. So, from a numbers perspective, some of them will inevitably not make it. And then in addition to that, you'll probably see a lot more people rolling non-Bitcoin assets onto the balance sheet to speculate, right? And that'll probably crash, and we'll probably cycle back to just BTC, and then it'll force people to think, okay, now that I have BTC, I've constituted my balance sheet with it, what can I do with it? So we definitely want to be there when that conversation starts up in earnest.
And Thomas, do you think all that happens in 2025?
Happens by the end of 2025. Yeah. I mean, it's accelerated way faster than I had thought, starting from even a year ago. So
yeah. I mean, certainly the public balance sheet meta is here, right? That's without a doubt. We'll see how quickly it expands to like the long tail of assets, right? Like we'll see if there's a Doge public balance sheet strategy here, and but yeah, like
I'm sure Truth Social will do something.
Well, yeah, there's that in and of itself, but similarly, like again, just kind of putting this momentum in perspective. Like in 2017, I remember speaking with Visa, MasterCard, and they were doing their early stables, like where do you guys think the action is? And then fast forward, Stripe's doing acquisitions in the space. They have publicly said that they have not only been working on it, but they are actively moving towards like distribution integration into their core products. I can't count the number of branded cards that allow you to spend crypto now. And then the backdrop of just a ridiculous amount of stable coins coming to market simultaneously. And so I think what we will ultimately see is this convergence of T-bills and then through stablecoin wrappers access to some combination of strategies on chain, right? Whether you're doing warehouse financing via DEX LP, whether you're doing delta neutral strategies, whether you're doing any other number of configurations. I think a lot of that, the access point will be through these stablecoin issuers. So I think that'll be a large, kind of trend that we see start to ramp up here in 2025.
Mm-hmm. Yeah, and before we wrap up, I'd love to hear from you guys. What should we be expecting from your organization this year? What type of release, strategic partnership? What are you excited about?
Yeah, so we expect to be part of multiple ETFs, powering multiple US ETFs and ETPs. And so we're very excited about that, and then very excited about our instant unstake product that will allow the Solana ecosystem to be able to easily unstake natively, and also allow market makers to participate in the staking ecosystem as well.
For us, we just went live on Aave about 2 weeks ago, which is a massive infrastructure unlock for us. We want to double down and kind of copy paste the Bitcoin Earn as a product that we do on Bybit with other large B2C platforms. And then we're excited about, if we do explore the route of an LST, we're definitely looking at high integrity TradFi based yield. So we're actively exploring that with publicly traded companies too.
And through all of the great work that Thomas is doing, we're just going to help them all borrow against that, mint our stable, and then give them the most capital efficient dollars on the back end. Thomas, I'd love to do that with you, by the way. That wasn't just in jest. But separately, so we have a number of partners who are looking at how can I programmatically deploy this capital on the back end, right? And so as Hadley and Thomas have talked about, in the context of portfolio management, I want some BTC, I want some ETH, and then maybe I want to go further out on the risk curve. I heard about insert your favorite token here, and can I use my dollars to start TWAPing into that while also having a principally protected position? And so you'll see more vaults from us that allow you to opt into those strategies over time. We're launching with a number of other distribution points, which that you will read about it if you follow our socials and you follow all of our channels.
Awesome. So time to wrap up the discussion. It's thank you so much. I think it's one of the most exciting topics in DeFi these days. So great to have you all around. And as we wrap up, if you were to make one bold prediction on the future of institutional DeFi, what would it be? And also, please, where can people find you on the social media? Who wants to get started with this one?
I'll echo the kind of bold prediction that we were joking about. Is I think the public company access is definitely the theme for the remainder of 2025. We'll see, but I'm actually betting that there will be a meme-driven public company holdco strategy that people can opt into. So I don't know if that's bold, but I definitely think it's coming. And if you want your Doge or Pepe access, hang on.
I'm going to take that a step further and say that we might see our first TradFi LST, where there's an LST that's wrapped in a pubco structure. And then for me, you could contact me on my email, thomas@fbtc.com.
Yeah, I guess I love the innovative and creative ideas. And I think the summary of that is I think you're going to start seeing this blend of TradFi and DeFi way more. So if you look at Sol Strategies, if you look at MicroStrategy, this idea of wrapping a public equity market around a crypto asset is just the very, very beginning. And once we have some kind of regulatory framework from a security standpoint, it's just gonna be crazy. I mean, I think you're gonna have very esoteric, very creative, different types of products that are going to be able to be generated. It may be a little overwhelming at first, but it's going to be very exciting and very interesting.
Hadley, what's your contact info? And then I'll throw mine out there.
Oh, yeah. So my contact info, sorry, Hadley Stern on Twitter or Hadley@marinade.finance.
And mine's David@xe.fi.
Awesome. Well, I think it's time to let all those ideas marinate in people's mind. And thanks again for everybody, all the listeners for joining. Thank you to our amazing panelists for a great discussion. And that wraps our Innovator series webinar on leveraging idle assets to generate yield on chain. Thanks, everyone, and see you next time.
Thank you.